So this video, guys, is going to talk about taxes and insurance, escrow in a creative finance transaction. And so if you like this video, take a minute and like it. Take a moment and comment below on the video or for any other videos you'd like to hear about. And take a moment and subscribe to this channel. So let's just talk about escrow for a minute. So when we're buying a home from a seller, if the property is debt-free, we want to check our taxes, guys, and make sure that there aren't any tax arrearages that are out there. You can do that by having your closing agent order a tax cert, or maybe you can go to the tax assessor's website and check it. It's usually pretty good. The tax assessor's website you got to be careful with because oftentimes the county only lists the county taxes, and you may have to go to the school's website in order to get the school taxes. And in many cities, they bifurcate these. Sometimes your local county CAD, the county appraisal district, will incorporate both of those on the local website. And guys, if the taxes look unusually low, there might be a good reason for that. Make sure you've double checked everything and you're including all the taxes in there. Now, when you're buying a home subject to the existing debt, 99% of the time, the underlying lender is already collecting taxes and insurance, and you can usually assume that those taxes are being paid current, unless your seller is in arrears. So be certain that you read your mortgage statement properly and watch for things in deferments. Check out the tax authority in your local county and make sure all prior taxes have been paid so you know what you're getting into. From there, you can get a reasonable estimation of what taxes are, and hopefully you are able to obtain a copy of your seller's insurance policy so you know what their annual premium is. So now you can get a good feel for what your taxes and insurance are. In addition, make certain you're looking at that mortgage statement to see if the lender is charging mortgage insurance or property mortgage insurance. They're called PMI or MIP. Same thing. Now, when we are selling a home with owner financing, we've got to be very cautious. Again, we cannot charge our back-end buyer for fees or services they're not receiving. So you can pay a lender on a subject-to transaction, mortgage insurance, but you cannot pass that through to your back-end buyer because you're not giving them mortgage insurance. So how do you adjust for that? Raise the sales price a little bit, raise the interest rate a little bit to compensate for that dollar amount, or just understand that it's there and it's going to be a cost and expense that you have to eat. Now, negotiate your transaction correctly for your back-end buyer to ensure that their taxes and insurance are fairly accurate. Keep in mind, guys, if you buy a house for $100,000 and it's being taxed at that and you sell it for $200,000, what's going to happen? Taxes are going to go up next year. Don't put your buyer in a financial strait by letting them think that their taxes are only being taxed on $100,000 when you know good and well they're fixing to go up to $200,000. Go ahead and estimate the higher tax amount to ensure things are handled properly at closing for you. Next, when a buyer on a wraparound mortgage is paying taxes and insurance, and you have in turn bought that property subject to the existing debt where that underlying lender has escrow, your loan servicer is going to collect the escrow from your borrower, and then they're going to pass that on through to the back-end buyer, or excuse me, to the back-end mortgage company. Now, sometimes when we buy these properties, taxes or insurance may be too high on the front end and they're lower on the back end. Your mortgage company is going to take anywhere from 3 to 6 months to adjust to those items along the way, so that if your buyer's insurance, let's say, is $100 a month less than what the original insurance policy was when you bought the property, the mortgage company is not going to change that day one. As I said, it takes them anywhere from 3 to 6 months to make those adjustments along the way, meaning it's going to hit your cash flow $100 a month. But the good news is all that excess money is going into the escrow account that's actually yours. and eventually you'll get that money back. So just understand how that flow works back and forth. The other thing I see that's problematic is how write-offs are handled. You get to write off what you pay. So if you are a homeowner paying the investor, you get to write off the interest and the property taxes that you're paying. And as the investor, we're collecting that interest, meaning it's income, and the interest that we're paying our mortgage to the mortgage company that we took over subject to, that's going to be an offset to the interest we're collecting. So hopefully you're making money there. And the taxes that we're actually paying to the mortgage company is our write-off. So it's understanding the flow of escrow properly, which is all important when you're thinking about and considering escrow. So guys, if you thought this information was useful, take a moment and like this video. Take a moment and subscribe to our YouTube channel as well. If you've got comments, take a minute and fill out below about this video or other videos you'd like to see. And if you like to learn more about creative finance and how to do it properly, take a moment and visit us over at theownerfinancenetwork.com, where you're going to find our paid training videos, as well as a lot of information about all the services we provide for you for your very next owner finance transaction. Guys, we'll see you all next time.